Good afternoon, everyone, and welcome to today's webinar. I'm Lisa Sturtevant. I'm Chief Economist with Bright MLS, and I'm really happy to be with you all today. We're going to talk a little bit about the Baltimore area housing market, where we've been, try and take a look into our crystal ball and see if we can tell where the housing market might be headed. And as always, please do share your comments, your questions. You can use the Q&A feature in the Zoom webinar. I'll also have this webinar recorded, and the recording along with the PowerPoint will be available on Bright MLS's website, and you can share it with your clients, with colleagues, with anyone you think might be interested. So let's get going. As you know, it is a very unusual housing market. Housing market activity has really sort of ground to a halt as mortgage rates have topped 7%, a lot of economic uncertainty around. And oh, by the way, it's also the end of the year when things tend to slow down anyway. And so we've seen a really big contraction in home sales activity as we've headed into the end of the year. And there's some reasons to think that that might continue as we head into 2023. But let's take a look and see where we've been. I like to start by looking at the number of closed sales. So these are closed sales in 1 month compared to the same month a year ago. In October, the number of sales in the Baltimore metro area were down 33% compared to where we were last year. That is a pretty big number. Home sales have been down year over year for several months. At the beginning, it was because there was just such little inventory. There wasn't enough for anyone to buy. So buyers weren't making offers because there wasn't any inventory. Now, though, we're really seeing the impact of these higher mortgage rates on buyers who are finding their purchasing power is being seriously eroded. So they're sitting on the sidelines. They're taking a wait and see approach to see if rates are going to fall. A little good news this morning. We did see that rates did tick downward, and hoping that that is a trend that will continue in the months ahead. But look, we had a bigger year-over-year decline in sales in October than we did back in May of 2020 when the pandemic hit and shut down the economy and shut down the housing market. So this is a pretty big contraction and really a pretty big about face from the very rapid housing market we had just in the first half of the year. If you look at the map on the side, you can see, of course, that home sales are down across the Baltimore region. The biggest dip was in Anne Arundel County, sales down 41% year over year. But we really are seeing slower sales activity as there's fewer buyers in the market. Despite the fact that the number of transactions is down, we are still seeing price growth. So in October, the median price in the Baltimore region was up 3% compared to a year ago. That is obviously less than the price growth we've been seeing earlier this year and last year. It's about the long-term average price growth. What I mean by that is typically if you go back 8 or 10 years, every year home prices were rising about 3% in the Baltimore region. So while the rate of price growth has fallen, it's really in line with where we've been in recent years. I do expect we'll continue to see a slowdown in price growth, and we will see prices fall from their peak levels, but it's going to take a little time. And even as home prices do fall from those peak levels, we're still going to be way above where we were in 2019 before the pandemic hit. So I'll talk more about that in just a minute. But if you look at the map, you can see home prices up 7% in Baltimore County. We're seeing prices up in Harford, Carroll, and Anne Arundel counties as well. We did see the first year-over-year decline in the median price in Howard County, but I do think this is a product of the mix of homes that were sold this year compared to a year ago. So it's something that we'll keep an eye on. We do know that prices ran up pretty quickly in Howard County, but inventory is still pretty tight, and I expect that we'll see a little bit of a different story next month when the data come in. As I mentioned, prices are continuing to rise, and the primary reason why prices are still rising is because inventory is still relatively low. So this chart shows the number of active listings at the end of the month compared to the same month a year ago. And in October, we saw for the second month in a row, a little bit of an increase in the number of active listings in the Baltimore metro area. And despite that increase, though, inventory in the region is still very, very low. I mean, look where we were back in September, back in 2020 and in early 2021. where inventory was down 50, 60, 70% year over year. So we're starting to build back up, but the number of active listings in the market in Baltimore is still less than half of what it was 3 years ago. So while there is inventory expanding, and the number of active listings is growing mostly, almost entirely, because the number of contracts coming in is down and homes are staying on the market longer. And so they're rolling into that active listing number. So you can see inventory's up in most markets across the Baltimore region. And Carroll County inventory was actually down 8.7% compared to a year ago, kind of flat in the city. But the question that we had here is about some stats, Maryland stats for October, and the numbers that you're seeing in the Maryland stats don't match what is here. So that I really appreciate that comment. Maybe you can follow up with me afterwards via email, because I want to make sure that we're not putting out confusing information, because we should all be singing from the same hymnal, as it were. And so I just want to make sure that that we're all looking at the same data, because there is a lot of data out there, and we are pulling the information that comes in from agents and brokers when they are putting in listings and closing sales, and should reflect what's going on in the market. So I do want to make sure, though, if there's some discrepancy, that we can address that. So moving forward, though, let's talk a little bit about where the market might be headed. And we do know that the number of pending sales in the Baltimore market was down again at a pace that sort of mirrored what we saw back in spring of 2020 when the pandemic shut everything down. Pending sales down 36% compared to a year ago, really down across the region. Those higher mortgage rates putting people out of the market, making people kind of take a step back, a wait and see. Frankly, people just fatigued by all the sort of whiplash in the housing market, getting ready for the winter holidays. Everything's kind of slowing down. And I think that's really going to be the story for the day, for the rest of the year. As a result, we're seeing that homes are remaining on the market a little bit longer than they did before. Sort of median days on market in Baltimore is around 12. You can see it's getting, as high as 18 days in the city of Baltimore. Still a lot lower than where we were prior to the pandemic. But buyers are taking a little bit more time, as they have a little bit more leverage in the transaction. It is still very much a seller's market, but now home buyers are able to take their time. They're able to ask for home inspections and appraisals, and maybe even shop around a little bit more. They're not going to find a lot of inventory out there, though. And it is still one of the situations that if you're working with a buyer who really does need to move, if they find a house that they love, they make sure that they have their financing ready to go and that they're ready to move, because we're finding that sellers who are pricing their homes appropriately, given this current market, are finding pretty ready buyers, and homes are still selling pretty fast. This median days on market, what this means, if you want to think about it this way, is half of all homes that sold in October went from listing to contract in less than 12 days. And that is still very fast, relatively speaking. It's just up from where we've been over the last couple of years. So there's this question about, like, where is the market headed? We're hearing a lot of news about at the national level about the housing market contracting. I mean, you'll hear one analyst say that there's a housing market crash coming. You'll hear other analysts say that the housing market's just fine and is going to be really stable in 2023. And it's really hard sort of to work your way through all of those, all of that information. And it's actually more important than ever to be paying attention to what's going on in your very local market. So as there's prospective buyers out there who are thinking about buying, a seller who might be thinking about listing their home or who needs to move, working with someone at the a local realtor who understands local market conditions is going to be really important to help sift through some of the noise that is out there about the national housing market. We tend to be here in the Mid-Atlantic, a pretty plain vanilla kind of housing market. And what I mean by that is, we don't have the wild swings like a Phoenix or a Austin or a Tampa might have. And as we go through kind of this housing market resetting, that's actually a good thing. It means that, we didn't kind of surge as fast as some other places, and we won't sort of correct as dramatically as some other places. There is some national news out there that I think is on a lot of people's minds as they think about the housing market and they think about the ability for people to buy a home. And one of those measures, of course, is inflation. We got pretty good news on inflation last week, where in October, the inflation rate was 7.7%. So that means that in October, a bunch of stuff that we buy on average was 7.7% more expensive than a year ago. That may not necessarily sound very good, but it's down from above 8%, which is where it had been for a few months. And the reason why we're paying attention to that is, there's a couple of reasons. When people are spending more and more of their income on groceries and gas and other family necessities, it's really, really hard to think about saving for a down payment or for someone who might be thinking about making a move, because that comes with a lot of other expenses as well. We also watch inflation because as we got this latest report on inflation, there is a lot of talk that, we're thinking that maybe we've hit peak inflation. And not only that, maybe the Federal Reserve's rate hikes have actually been having the effect that they wanted to. We know that the Federal Reserve has been hiking the federal funds rate, which is the light blue line on this chart. The goal is to to make an impact on consumer and business demand so that businesses and individuals would pull back on spending. And then that would allow demand to fall. So inflation would come down, prices would stop growing so quickly. And that's the tool that they have to try and tackle inflation. And there was a lot of concern that it wasn't really having an impact as we saw those inflation numbers staying over 8% in August and September. Well, with this better than expected report in October, there's some talk now that the Federal Reserve might be able to stop acting quite so aggressively on rates. It is very likely that they will still raise the short-term rate in December at their December meeting and in the beginning of 2023. They don't think their job is done yet in terms of bringing inflation down. They want inflation down around between 2% and 4%. And even though 7.7 is down, it's definitely not down to 2 to 4%. But we might have seen a little bit of relief on the mortgage rate front. And in fact, when we got that really better than expected inflation report, we saw mortgage rates drop pretty quickly. This morning, we got the data from Freddie Mac that shows that the average on a 30-year fixed rate mortgage was 6.61%. That was down about a 0.5 percentage point from just from a week ago. And that is sort of the market reacting to the fact that maybe the Federal Reserve is going to ease off on some of these rate hikes. We may have seen peak inflation, but peak mortgage rates, but I think it's actually more likely that we're going to see a lot of volatility in mortgage rates here as we move through the end of the year and into 2023. There's still a lot of economic uncertainty out there. And you may be working with buyers who are thinking that maybe they could try and time the mortgage rates, sort of take advantage of this volatility to try and get in when rates dip. We track home sales and new contracts on a weekly basis. And when mortgage rates dipped last week, we didn't see any sort of surge of buyers in the market coming in to take advantage of that dip. I think what's probably more prudent for buyers is to make sure that they are, shopping around and getting, quotes on rates and terms from multiple lenders to find the rates and terms that best fit their personal financial needs. Timing the market is really tricky. But all that's to say is there is some sense that we might see rates kind of stabilizing now here in the high 6s, as opposed to, I think there was a lot more fear earlier this month that rates would go up 7, 8, maybe even higher as we went into 2023. It's not out of the question. I do think 1 month of inflation data is that's all that is. It's not a trend. So we want to see how the inflation picture looks in November, and that will help us feel more assured that the Federal Reserve might be done with its very aggressive rate hikes. Because we know that higher mortgage rates have really eroded buyers' purchasing power. I think I show a chart similar to this every time we get together here each month. But it's really important for sellers to know that buyers are not shopping the home price as much as they are shopping their monthly payment. And while the median price in the Baltimore metro area was up 3% year over year, the typical monthly payment rose by almost 60% over that same time period. And that's making it really, really difficult, particularly for first-time home buyers who are maybe bringing 3, 5, maybe 7% down and looking to get into their first home. Repeat buyers, right, or move-up buyers are able to roll probably significant equity into their new home purchase. They're able to buy down that loan a little bit and are in a little bit better position than first-time buyers. But there was the National Association of Realtors released their 2022 profile of home buyers and sellers recently, and the share of home sales that were to first-time buyers was 26% in 2022. So 26% of home sales were to first-time home buyers. That is the lowest first-time home buyer share in 4 decades. So there is definitely evidence that first-time buyers are really having a much harder time than those who have equity in their home that they're able to roll into their next home purchase. I think there's a lot of expectation that as mortgage rates have risen and buyers' purchasing power has been eroded, that prices are going to have to come down, right? Just because the simple fact that buyers can't afford to pay what sellers might have been getting 6 months ago or a year ago. And I do believe, and we have already seen home prices falling from their peak levels. Home prices have a seasonal sort of nature to them. They tend to peak in the summer and they tend to fall off from those peak levels in the fall and the winter. And we've already seen that in our local markets. What we haven't seen is a big dramatic drop in home prices. And I don't expect that we will. The biggest reason is because inventory is still very low. I mentioned this is it's an unusual housing market because we're seeing buyers, the demand contract, but we're also seeing supply contract. So we're not seeing like we did back in the Great Recession when demand fell and then supply surged. Instead, we're just seeing the whole market kind of contracting, and buyers who are still in the market are still finding it's pretty competitive. Sellers are having to negotiate on price in a way that they didn't have to a year ago. And they are dropping their list price, but so far, and there's no evidence to suggest those price corrections are going to be dramatic. In order for us to see prices fall back below where they were prior to the pandemic, like if we wanted to know what would have to happen for us to see home values back to 2019 levels, in the Baltimore area, we'd have to see home prices fall 24% from their peak. And you can see in some other places they'd have to fall even further. In Baltimore, for example, where home prices have been rising pretty steadily, prices would have to fall 35% in order for them to be back down to 2019 levels. So I think, again, as you're working with prospective clients and they're worried that they might have bought at the peak, and what if home prices fall? For folks who have bought a home to live in, who are planning to stay there for a few years, there's no evidence to suggest that home values are going to be seriously eroded as we sort of work through this slower housing market into 2023. One of the things that I've been trying to ascertain is are there risks in our local markets, and what would make us think that home prices could fall? And so I compared Baltimore to the other 50 largest metro areas in the US on a few different measures that might be related to how risky the housing market is in terms of home price declines. That's embarrassing. I had Philadelphia listed up there, and of course, this is not Philadelphia. We're in Baltimore. And when you look at the Baltimore metropolitan area compared to some other places, Baltimore sort of shows up pretty favorably compared to some other places. So let me tell you what I mean by that. In the first table, we have what I'm calling inventory rank. So this is a measure of how fast inventory has grown in these metro areas over the last year. And we know that if there's a housing market where there's a surge of supply coming on the market, that's where there's a greater risk of prices falling. And the top 5 you can see there: Phoenix, I was not surprised at; Raleigh and Nashville, a little surprised that they've seen inventory expand as fast as it has; Austin, Tampa, rounding out the top 5. Out of 50 metropolitan areas, Baltimore ranks 43, meaning that inventory has grown year over year, but that increase has been pretty modest and sort of puts it at a lower risk in terms of, supply increases, leading to prices falling. I also took a look at, how the buyer side of the market is doing and looking at the change in the number of pending sales in October compared to last year at this time. And pending sales are down the most in San Jose, California. Pending sales are also down pretty dramatically in Virginia Beach, which is really interesting and reflects a little bit of the fact that Virginia Beach is one of those seasonal second home markets that saw a surge of buyer interest during the pandemic and now has definitely seen a pullback in buyer activity. Riverside, California, Portland, Oregon, San Diego, California round out the top 5. Baltimore actually ranks 16th out of 50, so in the top third in terms of the year-over-year decline in pending sales. That means that buyer traffic has been, a lot slower than it was a year ago, and does suggest that, the housing market might be a little bit slower in Baltimore than in some other places. But when we look at the last measure, and that's the unaffordability ranking, the places where housing costs are, much higher than incomes, you can see the California markets are really where housing is most unaffordable. In Baltimore, we rank 45th out of 50. Which means that the Baltimore metro area remains a relatively affordable market compared to the other 50 largest metro areas. All that's to say is, as we move through this housing market transition, we will see prices fall from their peak, but I'm not seeing any signs in any of these metrics that compare Baltimore to other places that we should be worried about a major correction in the Baltimore area. If you have questions, please don't hesitate to put them in the Q&A, or if you have comments about what you're seeing in the market. I did want to make sure that you knew about our weekly market reports, which come out on Tuesdays at 8 a.m. We do our monthly home sales reports, which are out around the 10th or 11th for Baltimore, Philly, and the DC metro area markets with some great infographics. And then stay tuned. We talked a little bit about some of the factors that might influence the housing market in 2023, but I'll be putting out Bright's formal economic and housing market forecast in early December. I'm just polishing up that crystal ball a little bit more, see if I can get it a little bit less cloudy, since there's a lot to parse through. And I will say that if anyone tells you that they're 100% sure that they know where the housing market's headed in 2023, I would take it with a grain of salt. My goal is to help us all think through what are the things that we should be watching to help us understand where the market might be headed and help us be more of a resource for our clients and our colleagues and our communities. And that's really our goal here in the research department at Bright, is to arm you with information. If you're looking for the weekly stats, you can go or any of this stats, you can go to brightmls.com/research. The website is here on this last slide. If you have any trouble at all finding any of our information, please don't hesitate to reach out to me directly. Connor Christie is our market research analyst. You can reach out to him as well. If you're looking for something and you can't find it, let us know. If there's some other type of data or information that you're interested in, you think we might be able to help find it, we would be more than happy to do that as well. So I am really grateful for the chance to